everybody. Matt St. John with Street John Realty here with Sam from Sam Elwell Realty, Tyler Bogle Group. Today we're going to talk about inflation. What the is it? So, Sam, please introduce yourself.
Well, hi, my name's Sam Elwell. I'm a realtor here at Keller Williams. I was born and raised in Alaska. I guess relevant experience to the topic of today's discussion of inflation. I've been studying this stuff from an investor perspective for about 9 years now, which is a good chunk of my life. I went to college, got my bachelor's of science in business and psychology, and studied economics there as well at a few different institutions here and abroad. Since then, I've got my real estate license, been doing that for 3 years now.
Nice. So, please define inflation for us.
So, inflation at its basic level is increase in prices over time. So whenever you go to the store, your chicken nuggets cost $3 more than it did last year. The price inflated.
Okay, so why does inflation exist? For instance, we had, say, a service 100 years ago that cost X amount of dollars. We'll say 50 cents, right? And then 100 years later, it's $500 for the same service or the same product.
Yep.
The product hasn't changed. Everything's technologically the same. Why is it now 100 times more expensive?
Well, it could be three different factors of either demand pull, where the demand for the product goes up, and so the demand can't keep up with the supply, and so...
Or the supply can't keep up with the demand.
Correct.
Yeah.
And that results in an increase in price.
Okay.
And then the other side is cost push. So the cost of raw materials goes up to manufacture that same good.
Okay.
With finite resources, sometimes scarcity makes it more expensive, or other issues going on around the world cause something to increase, like the Houthis blow up a ship in the Red Sea, and now shipping has to go around the world an extra 100, 200 miles, and that cost to ship that good goes up, and that results into an increase in purchasing price.
Okay, so that's talking about like specific products.
Right.
And you said it was cost push and demand pull?
Correct.
Okay,
Yep.
cool. Remember those terms, look them up later.
Yep.
I know I'm gonna have to, because I'm still in the infantile stages of my understanding of this whole process. That's why we're doing this.
Yeah.
So that's for specific products, right? Yep. As a whole, like the value of currency, what is the purpose of inflation?
Well, backing up, there's a third cause of inflation, and that is what's known as built-in inflation. And that's basically whenever costs and goods of services go up, and now you can no longer afford things that you used to be able to afford, and so you demand a wage increase from your employer. And so now the employers are paying more just due to demand in the labor market. And so that's built-in inflation, and one of the main causes of built-in inflation is an expansion of the monetary supply. So the Federal Reserve will print more money, essentially, and now with more money in circulation, now that causes almost like a gradual wage price spiral, to where wages go up, then prices go up, and prices go up, then wages go up.
Right, so we're on this never-ending sort of escalator.
Right, and we're not quite to a concerning point there with wage price spiral, but that's the job of the Federal Reserve, is to stabilize prices to prevent wage price spirals that lead out of control and destroy economies.
Gotcha. Okay, so what are some of the mechanisms that they use to control inflation?
So they do have restrictive monetary policy, and that is kind of a complex subject
Yeah.
as far as quantitative easing goes and
Mhm.
all of those things. But basically, drawing parallels from like real estate is
Okay.
that by having more restrictive monetary policy causes interest rates to go up. If interest rates go up, then the purchasing power of more consumers goes down, and so less people can afford homes. And if less people are buying homes, then inflation doesn't increase at a
As steep of a level.
yeah.
As fast.
Right.
Yeah.
And that's what's known as disinflation.
Okay.
It's a decrease in inflation. It's not deflation,
Right.
but it's in between those two. It's just a
Gotcha.
slower rate of inflation.
So where are we at right now, economically, in the U.S.?
Well, right now the Federal Reserve is hemming and hawing over their inflation target of 2%. They want a long-term inflation rate of 2%, and right now we're above that. I think we're in the mid threes, I want to say, almost maybe, yeah, mid threes. It depends on the month and the summary of economic projections and the CPI and consumer price index data and the personal expenditure data that comes out with the Federal Reserve's reports. And a lot of that has to do with a culmination of a bunch of different factors as far as how the economy's doing.
So if we're at 3.5%, what are the projections over the next 6 months to a year?
Well, they're gradually getting down to the 2% just with holding the interest rates where they're at now, or the restrictive monetary policies that
Okay.
they have right now. They're wanting to do maybe potentially more quantitative tightening, but that doesn't necessarily mean that interest rates will change. We're actually expected to have, depending on who you ask and who has the crystal ball at the time, we're expecting about 3 rate cuts this year still. I think maybe it's closer to 2 rate cuts this year.
Well, from what we've seen already, they've gone up a little bit,
Right,
over the past month.
right, and a lot of that's baking in prices for the future, depending on the markets, because the Federal Reserve changes one thing, and then there's a lot of trickle-down effects where the banks will pay certain amounts based on their risk tolerances.
Right.
And demand for that within, Fannie Mae and Freddie Mac, which are pseudo-government agencies to ensure that mortgages are liquid and they can lend on them.
Okay, gotcha. So where we're at right now, and this may be going back a little bit far for you, you're a younger guy,
Yeah.
but 2008, how does that compare?
So 2008, the cause of 2008 was a subprime loan mortgage or subprime loan crisis. So they were basically giving out loans to anybody and everybody. The janitors getting a $500,000 loan to go buy a mansion, and then they did this on a large scale across the country with selling subprime loans to Wall Street. And what inevitably people couldn't afford the mortgages that they were given. Whenever you're making $40,000 a year, you can't afford a $500,000 house.
Right.
And so inevitably you foreclose, and the stacking up of those foreclosures caused the 2008 real estate bubble.
Right.
And that's different from now because if you've tried to get a loan recently, it's a difficult process comparatively. So you have to have the right debt to income ratio, you have to have the right credit score, there's all sorts of background checks for that. And, I'm not a lender to really delve out of my area of expertise a whole lot there, but the borrowers are a lot more qualified today than they were in 2008.
Right. Well, people are a lot more educated on what's required.
Right.
I would say I don't think it's a lot more difficult. It's a lot more regulated.
Right.
If you are using the right lenders and the right professionals on your team to get it done, you can still get it done, but they're going to do it in a deliberate way that you're not going to be house poor or put into a bad spot.
Right.
Right?
Yeah.
Everything's
It's
going
for
to be
your
much
best
more
interest.
deliberate, right?
Yes.
Much more realistic.
Mm-hmm.
Yeah.
Right.
If you have halfway decent credit and a couple bucks in the bank, you can still get into a home.
Right.
Yeah.
Right.
So
Yep.
based off of that 2008 information, the people that are crying that the sky is falling with the real estate market, what would you say to that in comparison?
Well, it's a long-term asset, and especially if you're concerned about, topic of today's discussion, inflation, a long-term 30-year loan is actually the best inflation hedge that you can get, because if you're buying a $400,000 property today and you amortize that over 30 years and you have, 5%, 7 percent interest, if you have an annualized or a long-term inflation rate of 2%, that means your purchasing power for other things is going down by 2% every year. And so if you have an asset that's worth, $400,000 today, by the time that you've paid off that loan in 30 years, that asset is, doubled, tripled in value, but you're still paying on that same initial value.
Right.
And you're also
in the same way with monies it's worth that what it was when you got the loan. Right. And that's not including your annual appreciation. Right. Which is currently in Alaska outpacing your inflation by over double.
Yeah. So it's the accumulation or a culmination of inflation and appreciation.
Correct.
And so between those two things, you're paying down an asset that's going up in value, and your purchasing power for other things is going down in value because everything's more expensive.
Right.
And so it's kind of the best way to really invest over the long term, because, historically housing prices have gone up over the long term. I don't think there's a particular decade where
there isn't.
Prices have gone down. If you have a long-term perspective,
a 10-year period, out of a 10-year period, they've always gone up. Right. There's like, even in Alaska, I've said this on a couple of other videos as well. 2008, they lost a certain percentage of the value, of the market, and say the average value for homes, appreciation for homes, was 3% across the entire United States per year. So in a 10-year period, it would be a 30%, give or take, appreciation, right? So within that 10-year period, Alaska had recovered its losses and gotten completely back on track to meet that 30% after 2018, right? So it had completely dug itself out of the hole and gotten immediately back on track with the average, right? Currently, we're averaging over 5%. Over the last 5 years. That's
which is great, and a long-term perspective, I think Alaska's in a great position as well. I mean, historically, it's been a boom and bust economy where things have gone in peaks and valleys economically, just due to the discovery of resources, and in the 80s we had a big bust cycle here because the oil dried up, and part of that was actually going back to inflation. We had out of control inflation in the 80s, and the chairman of the Federal Reserve at the time, I believe his name is Paul Volcker, he had to restrict monetary policy to the extremes to fight inflation back then. That's what we're trying to avoid now, and try not to over tight like they did back in the 80s, but that's why we had 16-18% interest rates in the 80s. So,
but the interest rates now are historic highs, right? That's a joke.
It's a joke.
It's a joke.
Yeah.
A lot of people, again, the Chicken Littles are screaming and crying about historically high interest rates, when that's just factually not the case.
If your history goes back 3 years, then maybe. But
super short-sighted.
Right.
Historically, what are interest rates at? What are the average interest rates at for mortgages?
So the average long-term interest rate for mortgages is around 8%.
Right. And we're in the 6s right now. Right. So we're 1.5, 2 points under the average for what amount of time since they started recording it?
Yeah. So, which is About 50 years of data.
50 years of data. Okay, cool. So that's a pretty good sample size.
Mm-hmm.
And we're now still, under the average by 20%, give or take. Yeah, that's pretty good. Cool.
Yep.
So, is there anything else you want to touch on before we go?
Not too much. I could really delve into the weeds and talk about this all day, but yeah, that's kind of the basics of it and the scope of today's conversation.
And we're going to deep dive a little bit more. This is a little bit of a taste, so to speak, of future content. So the terms that we really should probably become familiar with in the future: cost push, demand pull.
Yep.
Is that correct?
Yep, and then built in.
And built in.
The
Okay.
three
Cost push,
main-
demand pull,
Yep.
and built in regards to inflation.
Yep.
So I highly recommend that you guys each do your own research onto those three simple terms. There's a plethora of data available online regarding those terms, and that will make you much, much, much more intelligent on the conversations when you see people talking about them online, a lot of times in error. All right. And it will actually arm you with the correct information to make your own financial decisions moving forward. So anyway, more to come later. This is just volume 1 of many. So we'll be in touch, guys. Thank you very much.
Nice to be here and
Yeah.
good talking with you.
Yeah, thank you so much, sir. Bye.
Yep.